all the currencies are bad because they all print money. But the currency that where you can't print money, the true currency is gold. I firmly believe that every citizen that is concerned about his country and his own well-being should own some gold and silver. Physical. Now, you want to make a lot of money. In a bull market of gold, the gold shares and silver shares go up more than the physical, but not always. And there's a higher risk.
The recent surge in gold and silver prices can be attributed in part to the escalating currency risks facing fiat currencies, particularly the US dollar. The rally gained momentum as the US heightened threats to seize Russian dollar assets, highlighting the vulnerability of traditional currencies to geopolitical tensions and foreign policy maneuvers. Renowned economist and investor Marc Faber underscores the intrinsic value of gold as the only true currency immune to manipulation through printing. Faber advocates owning physical gold and silver as a hedge against currency devaluation, emphasizing their role as stable assets amidst uncertain economic conditions. Gold's record-breaking performance, fueled by central bank purchases and geopolitical uncertainties, has positioned it as a favored investment option. Recent data show a remarkable 23% increase in gold prices over the past 6 months, with gold and precious metal funds dominating the performance tables for March 2024. Analysts speculate that this trend may persist into April, further underlining the appeal of precious metals as safe haven assets. Despite the remarkable rise in gold prices, shares of gold mining companies have not experienced commensurate growth. This disparity can be attributed in part to a significant increase in production costs, up by 35% since early 2020, driven primarily by rising labor costs. Faber acknowledges the potential for higher returns from gold stocks in a bullish market, but cautions investors about the accompanying risks. While gold shares offer investment opportunities, they entail higher risks than physical gold, highlighting the importance of informed decision-making in navigating the volatile landscape of precious metal investments. Come along as we explore the valuable insights provided by Marc Faber. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
The price of gold experienced a true breakout on the upside. There are false breakouts, but this one is a true breakout because it was met by skepticism among individual investors. Individual investors, they go to a party and tell their friends, oh, my gold has gone up a lot. When you dig, how much do they have? An ounce or two? Very few people have 20 to 30% of their assets in gold. Very few.
You're right, and I'm sure
it's not the best investment, but it is a safe investment. I would tell your viewers and listeners that they're making a mistake if they don't own any physical gold at all. That's all I can say. I explained that gold is true money. I explained that people are underweight gold. I explained that in an environment where the purchasing power goes down of paper money, gold is one way to hedge against the loss of purchasing power. The buying signal was when a British treasurer, Gordon Brown, in 1999 sold his gold, or part of his gold, at less than $300 an ounce. That is the perfect buy signal because it shows how dumb the central bankers are. That is concerned about his country and his own well-being should own some gold and silver. Physical. Now, you want to make a lot of money. In a bull market of gold, the gold shares and silver shares go up more than the physical, but not always. And there's a higher risk.
So let's talk about gold. And once again, you were stressing the importance of being invested in physical gold as opposed to the miners. And the miners are really underperforming. If you look at Newmont, it's still down on the year, I believe, somewhere around 5 to 10%. And that's in spite of gold being at $2,300 or up over 10% on the year. And I'm sure a large part of that has to do with their margins being squeezed due to the high cost of oil, the high cost of labor. So you make a very good point about investing in the physical.
Yes, I mean, it's remarkable. I mean, I follow stock market since 1970 closely because that's when I started to work on Wall Street. And of course, I followed the gold market since the 60s and 70s. I saw the gold mania and silver mania in 1978, 1980, and then the collapse in prices and then the renewal of the uptrend after 1999. But the point that I want to make is gold shares at the present time are incredibly low compared to the physical price of gold and silver. That's what you just pointed out with the example of Newmont mining, which I agree with you 100%. There are other stocks that are even more depressed than Newmont. The gold shares are also incredibly depressed against all the other stocks in the market. In other words, if you take gold share sector relative to the S&P, it's all gone down until just recently. Number two, if you, okay, in Canada, it may be a little bit better, but in the US, we can measure how much gold shares do portfolio managers own. It's among 66% or 70% is less than 3% of the portfolio. So people are grossly underweight gold, okay? But at the same time, despite this underweight position, they have zero interest to increase the gold position. Zero. Tells you something about the IQ level of fund managers.
According to data from the CME Group, traders are currently estimating a 52% likelihood of an initial 25 basis point reduction in June, reflecting expectations of potential rate cuts by the U.S. Federal Reserve. However, recent robust job expansion figures for March have surpassed forecasts, casting doubt on the timing of such rate decreases. In response to the solid economic data, investors are scaling back their bets on interest rate cuts for the year, signaling a growing conviction that the Federal Reserve may need to maintain higher borrowing costs to counter inflationary pressures. Market projections anticipate 2 quarter-point rate cuts in 2024, with only a 50% likelihood of a third cut, a significant departure from earlier expectations of 6 to 7 cuts. Amidst this evolving economic landscape, Marc Faber underscores a prevailing lack of confidence in the Federal Reserve's ability to address inflation effectively. Consequently, investors are shifting away from bonds towards equities. However, Faber warns against potential overvaluation, particularly in sectors such as the high-tech industry in the U.S. Let's return to the interview.
The millennials, they are born into a time when inflation didn't exist or was coming down, and they were born in a period of artificially low interest rates. Now, things have changed, but the young people, the Generation Z and the millennials, they're more interested in cryptos than in gold because they consider gold as a non-event. It doesn't move enough. Whereas the cryptos, you can get rich quick. This is a feature of every bubble, the get rich quick schemes. And I mean, I'm not saying that Bitcoins can't go to $200,000 or $1 million an ounce. It's like the tulip made in Holland. The sky is the limit. I have some reservations about Bitcoins and cryptos, whereas I think that gold is relatively safe if you keep it in a safe place. I wouldn't call necessarily Canada under the government of Mr. Trudeau to be a safe place to hold gold. I think that the market is reflecting the view among investors that the Fed will not do anything about inflation or will do very little, so that inflation will continue to accelerate in the long run. And in this environment, you don't want to own bonds. You're better off in equities. Now, there are some question marks about this reasoning, but this is what the typical fund manager thinks. In this environment, I think we have to be careful which sectors we buy, because in the US and also in other countries, the high-tech sector is now very expensive. They call them the Magnificent 10 or the Magnificent 7. These are stocks that are very popular, but also very expensive. In my view, there are markets around the world that are inexpensive. Inexpensive, as an example, is Hong Kong, China. That is very cheap. Hong Kong property companies, and you have a lot of Hong Kong Chinese in Canada, they've never been so cheap in terms of valuations. You have a lot of property companies that sell at a 70-80% discount to net asset value. Now, I do not argue that the net asset value will not decline. It will decline, but maybe not by 80%. You understand? So you're buying something that is very depressed And the media that for years and years told you that Hong Kong was great and China was great, now you cannot find a report by the media that would express any sentiment of optimism about Hong Kong or China. Everything is negative. So for that reason, I think that stocks in Hong Kong are cheap.
Interestingly, equity investors appear largely unfazed by the changing rate expectations, buoyed by positive economic indicators that mitigate concerns of prolonged low rates hindering growth prospects. What implications do the shifts in rate expectations and investor sentiment hold for the broader financial landscape? Share your thoughts in the comments section. If this video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.